Okay, lesson 28 is going to be a very short lesson, and it really is just a chance for me to discuss one of the problems that I've assigned to you on this whole topic of multiple deposit banking. And so the problem I've selected is the free response question from 2011, Form B, number 3. And we're going to start with part A as a way to kind of get us going here. Now, this is the information that the question gives you. The question posits a hypothetical bank, Sewell Bank, and this is the balance sheet that Sewell Bank has below. Now, the reason I wanted to do this question was because there's quite a few things in this question that we haven't seen very much before. Typically, when we looked at these questions, we've really looked at basically a few things. We've usually seen just demand deposits, which we know, of course, are usually checking account deposits, M1, and we've seen required reserves, and that, of course, is the percentage of money that the bank has to keep according to Fed policy. And then we see the amount of loans that the bank gives out. We have that right here. There are a few other things in this case that they've added, I think more as a distraction than anything else. For example, they've added this thing called owner's equity. What is an owner's equity? Well, it's actually very simple. All it really is money that the owner of the bank has put into the bank. In this case, he also put in, or she put in, $10,000. And in this column, we also notice a few other things. Excess reserves in this case happen to be zero. We know what excess reserves actually are. Excess reserves are additional money the bank chooses to keep that it does not have to. In this case, it's chosen not to keep any. Then two other things to mention down here. We notice this thing. First, the one on the bottom is pretty straightforward: buildings and fixtures. Of course, when a bank, there is actually literally the bricks and the cement and the mortar of the bank, and that is worth something. So that's an asset they put in there, and they obviously spent some of the money that was put into the bank on that. And then the last thing which I want to mention here is this thing called government securities right here for $7,000. Remember that securities are another way of saying bonds. So instead of loaning all of the money out that the bank had, it decided to spend some of that money on bonds and invest that way, which is also another way banks can invest. Ultimately, this doesn't change the approach to our question very much at all, but it's good to understand what all of these things are. So, the first question asks, based on Sewell's balance sheet, calculate the required reserve ratio. Okay, well, remember what the reserve requirement is. It's the percentage of demand deposits that a bank must keep on hand. Well, in this case, we can kind of ignore owner's equity. That's just the owner's money that he put in the bank. So we'll keep looking at demand deposits, $10,000. And since it appears that they were required to keep 2,000, 2,000 is 20% of 10,000, and therefore the answer is 20%. That one I think is pretty straightforward. Instead of this time them asking you what would the required reserve be if there was a 20% reserve requirement, they went backwards. They gave you the required reserve and asked you to find the reserve requirement. Pretty simple, 20%. Okay, let's continue along. Question B. Now I've recopied the chart that was provided in the question just so that we can see it again. Question B asks, suppose the Federal Reserve purchases $5,000 worth of bonds from Sewell Bank. What will be the change in the dollar value of each of the following immediately after purchase? Okay, so let's get our head around what just happened here. It says the Federal Reserve purchases $5,000 worth of bonds from Sewell Bank. So Sewell Bank already owns $7,000 worth of bonds right here on their balance sheet, right here. If the government purchases $5,000 worth of bonds, what's now going to happen? Well, let's take a look. First question asks, what's going to happen to the excess reserves? Well, what is the Fed going to give Sewell Bank in exchange for all those bonds? It's going to give it a whole bunch of cash. Cash, regular old cash. All of that cash now ends up here as an asset to the bank. Where should that money end up? Well, it's just $5,000 in cash. And what does $5,000 in cash that's not being loaned out or not being sold in bonds or not being put into buildings called? It's called excess reserve. So the answer is simply $5,000. The question that precedes that, or proceeds that, is what is there a change in demand deposits? And the answer in this case is no change. Why is there no change? Because the liabilities the bank has, the demand deposits have not changed. The way in which they've distributed that money in the form of assets changed from $7,000 in government securities and $0 in excess reserves to $2,000 in government securities and $5,000 in excess reserves. But remember, the total amount in the assets column has not changed, and it must equal the liabilities. So really, nothing has changed as far as demand deposits go. They are the same. All right, part C. And again, I've just reposted the chart at the top of the question. Question C is, calculate the maximum amount that the money supply can change as a result of the $5,000 purchase of bonds by the Federal Reserve. Okay, well, we've done a problem like this before. First thing we need to do is find our multiplier. So we start by doing that. Our multiplier is 1 divided by the reserve requirement. In this case, the reserve requirement we already determined was 20%. So the reserve requirement is 1 over 0.2, which leads us to an answer of 5. Now, from there, we use the multiplier to multiply the new money. So the new money being put in this case by the Fed times the multiplier would give us our final answer. The new money put in was $5,000 when the Fed bought those bonds from Sewell Bank. The multiplier was 5, and so the total amount was $25,000. Now, the only question we have to ask is, do we need to subtract that initial amount? And as it turns out, the answer is that we do not, because the money came from the Fed and was not already in M1. Therefore, the money is new and does not have to be subtracted. So our answer remains $25,000. Okay, finally part D. Part D asks us, when the Federal Reserve purchases bond, what will happen to the price of bonds in the open market? Now, we don't have to get very much into detail on this. It just says to give us what happens to them. It doesn't ask us to explain. But remember what the story is. The Fed purchases bonds. What happens when Fed purchases bonds? Well, we know that more money comes into the money supply, and therefore, very importantly, what happens to interest rates? Interest rates go down. And because interest rates go down, this causes the bond prices to increase. Remember, anytime that interest rates go one direction, bond prices go the other direction. And we discussed in our first lesson in this module why that was. Okay, I hope this is a helpful summary of this question. Please do the other free response questions assigned in this lesson.